Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 2, and this is Section H. This is an application topic, and this is a continuation of the topic from the previous video. Calculate the interest expense attributable to bonds payable, such as discounts, premiums, and debt issuance costs or bond issuance costs reported in the financial statements. Again, this is a continuation of the previous video where we talked about notes payable interest expense. We're going to be doing all that the Superfast CPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, it is a free 1-hour training where we will give you the key ingredients to passing the CPA exam, and we will teach you how to be effective and efficient with your studying so you don't waste months or even years of your time. And after you watch that, you're probably going to want to learn more, so make sure you learn about becoming a Superfast CPA Pro member. And just letting you know, we will only be going over 5 questions in today's video, but Superfast CPA Pro members, on top of course, getting access to the Pro course, which is the main benefit of becoming a Superfast CPA Pro member, they also get access to the 10 question versions of these 5 question videos, where I go over more questions, where they can get more practice and a bit more explanation on these topics that we're making videos on. So if you like this, make sure you check out becoming a Superfast CPA Pro member, because again, you'll get access to those full 10 question versions of the videos. With all that said, now let's dive into the questions to learn this. All right, here we are at question 1, and this is a pretty simple first question. This is kind of just priming us for the rest of the video. And a strategy that we always like to point out, it might seem a little silly with this question, but it's a good habit to be in for all of the questions. Always read the last part of the question first, because that will give you context a lot of the time for what you're dealing with. You know, it might seem silly right now, but during test day, you are going to be seeing questions from tons of different topics, 50, 100, 200 plus different topics. And if you read the last part of that question, it will give you context to know, oh, I'm dealing with bonds payable for this question. So you immediately know what you're dealing with as you dive into the question, instead of reading a paragraph or 2 paragraphs of information, and then at the very end realizing, oh, this is what it was wanting me to do. And then you kind of have to reread the whole thing again. So again, read the last part of the question first. It's a really good habit for test day. So let's start here. How much interest expense should Mercury Corp record on December 31st, year 1? Okay, we're dealing with interest expense, and we know that from the blueprint topic. On September 1st, year 1, Mercury Corp issued $500,000 of 8% bonds at par. The bonds pay interest semi-annually on March 1st and September 1st. How much interest expense should Mercury Corp record on December 31st, year 1? Okay, so with all that, again, we have to figure out what the interest expense is. It's very easy. Again, this is kind of an introductory question. Let's go ahead and just go straight to the answer so that we can start getting to the other questions where we're going to start talking about discounts and premiums and things like that. So let's go ahead and look at the answer. All right, the answer is C, $13,333. That is the amount of interest expense, or really basically accrued interest expense, if you think about it, that they're going to have as of December 31st. So let's walk through this. Only 4 months of interest, September 1st through December 31st, that's 4 months, need to be accrued by year end. The accrued interest expense is calculated as $500,000 multiplied by 8% multiplied by 4 out of 12, and that's 4 out of 12 months in the year. That gives you $13,333 of interest expense, or really accrued interest expense, that they're going to be accruing until they pay it on March 1st of year 2. And again, it's pretty easy because this one was issued at par. We don't have to do any amortization of a premium or a discount or anything like that. The interest expense is just what you calculate with the interest rate and the face value. So again, that was kind of an intro, just a simple question to kind of get us into this. Now we're going to go to the next questions again to learn about discounts and premiums. All right, here we are at question 2. Using the effective interest method, how much interest expense should Solace Corp record for the third payment on June 30th of year 2? Okay, so we're using the effective interest method, and it's the third payment, so let's be thinking about that as we read through this. On January 1st, year 1, Solace Corp issued 75 bonds at a 5% annual interest rate, each with a par value of $1,000. By the way, just letting you know, typically, from what I've seen, that is almost always the case. That's kind of like the common practice with bonds, is they're issued at $1,000. Maybe it'll be 100 or maybe 5,000 other times, but a lot of times you're going to be seeing 1,000. So if you see that in a whole bunch of questions, that's just kind of how it usually is. The bonds were issued for a total of $68,250 to reflect a market interest rate of 6%. Interest is paid semi-annually on June 30 and December 31st. So again, with all that information, we have to use the effective interest method to calculate the interest expense on the third payment on June 30th of year 2. If you've seen this before, in fact, I think we've kind of talked about some of this stuff in previous videos, just never explicitly about bonds payable interest expense. But if you know how to handle what is happening in this question, then go ahead and pause the video and try to figure it out yourself. If you have no idea how this works, that's okay. We are using these questions to learn how to do the material. So if you don't know, we're going to go straight to the answer. But if you do want to try, pause the video, do the calculation yourself, and when you're ready, come back. We'll look at it together. All right, here we are. The answer is D, $2,058 is going to be the interest expense on June 30th, year 2, which is the third payment. So we're going to walk through this. This is the effective interest method with a discount. So something that is not too complicated once you understand how to do it. With the effective interest method, interest expense is based on the carrying amount of the bonds, which increases as the discount is amortized over time. Here are the calculations for the first, second, and third payments, and we have to calculate the first and second payments before we can calculate the third payment because we're using the effective interest method, and you'll see why here. So for the first payment, on June 30th, year 1, the carrying amount is $68,250. That is the discounted value. That's how much money they actually got for the bond. It was a $75,000 valued bond, but it was issued for $68,250, and that would indicate a discount. So just letting you know, again, we're dealing with a discount here. Let's dive into this. So you would debit interest expense. And how do you calculate the interest expense? You multiply the carrying value, $68,250, by the 6% market rate, and then you multiply that by however many months that was running. In this case, that's 6 out of 12 months because these are semi-annual payments. So from January all the way to June, that's what's building up. So multiply that all together, that gives you $2,047.50 of interest expense. And again, you're debiting that. And you're going to kind of see a pattern here as we go through these questions. So let's go to this next part here. You would credit cash interest paid. So this is the interest that is actually paid. This is the cash actually paid. You use the face value to multiply that, and you use the stated rate for that. So again, interest expense, you're using the carrying value and the market rate. For the interest paid, you're using the face value and the stated rate. And again, still using 6 out of 12. So that's going to give you $1,875. And by the way, this will always be the cash portion paid of the interest expense for the life of the bonds. So for the whole rest of the time, for every single journal entry you make for this specific bond, the cash interest paid is going to be this $1,875. That is not going to change throughout the life of the bond, unless, maybe something crazy happens, but that's not what we're covering in this video. So $1,875 is the cash interest paid. Now we go down here, the discount amortization is the difference between the two. So the interest expense was $2,047.50, less the interest paid is $1,875. So that gives us a discount amortization of $172.50. Now, what do we do with this discount amortization? Discounts are where the carrying amount starts lower than the face value. So you are trying to amortize the carrying amount up to the face value. So when we amortize discounts, we are actually increasing the carrying amount each time by the discount amortization. So in this case, we take that carrying amount of $68,250, add the discount amortization, $172.50, and that gives us a new carrying amount after this payment of $68,422.50. So with all that, we're going to do that again 2 more times, but I won't, belabor it so much with the other ones. So now that we have this carrying amount, again, we do the same thing. To get the interest expense, we take the carrying amount, multiply it by the market rate and by the 6 out of 12 months because this is a semi-annual payment. That's $2,052.68. Notice that is greater than the first interest expense. So pay attention to that. Cash interest paid, same amount. And so because that's the same amount and because this has increased, the discount amortization has therefore increased because $2,052.68 less $1,875 is a little bit bigger than this discount amortization of $172.50. Now it's $177.68. So you'll see this, it's going to keep increasing as time goes on. We add this to the carrying amount, and that gives us a new carrying amount of $68,600.18. And then we finally carry that to the third payment, the thing we've been trying to get to this whole time. We take that carrying amount, multiply it by the same interest rate, that's the market rate, multiplied by 6 out of 12, because again, it's a semi-annual payment. That gives us $2,058. Technically, that is the answer right there. That is the interest expense that we were trying to calculate. But notice, again, that is bigger than it was the previous 2 payments, and the cash interest paid doesn't change. So that means that because this increased, the cash interest paid didn't increase. That means that the discount amortization increased to $183. And we would then, of course, add that to the carrying amount, but we're not going to go any further. That's all we needed to do. So again, I was trying to kind of hit this home This progression shows how the interest expense and the amortized discount increase with each payment as the carrying amount rises. And that's specifically when you're dealing with a bond discount. So I hope that all really helped. We kind of went step by step, pretty detailed. Now that we've done the effective interest method with a discounted bond, let's go to the next question. All right, here we are at question 3. Using the straight line amortization method, how much interest expense should Solace Corp record for the third payment on June 30th of year 2? Now, we are using the straight line method instead of the effective interest method, so that's good to know. Now we go to the top here. On January 1st, year 1, Solace Corp issued 75 bonds at a 5% annual interest rate, each with a par value of $1,000. Bonds were issued for a total of $68,250 to reflect a market interest rate of 6%. The bonds mature in 5 years, with interest paid semi-annually on June 30th and December 31st. So again, using the straight line amortization method, we have to figure out the interest expense for the third payment on June 30th of year 2. Now, for you sharp-eyed viewers or participants, maybe not even that sharp-eyed, this is the exact same question as the previous one in question 2, except now we are applying the straight line method instead of the effective interest method. So we're doing the same things, but with the straight line method, which is way easier, just letting you know. So maybe give this a try. If you've ever dealt with straight line depreciation, I think you could probably figure out how to do this one. Pause the video, do the calculation on your own, and when you're ready, come back. We'll look at it together to see how your try went. All right, here we are at the answer. The answer is D, $2,550. That is the answer. And again, this is way simpler than the previous one. Let's walk through it. Under the straight line amortization method, the bond discount is amortized evenly across all interest periods, resulting in a consistent interest expense for each payment. And by the way, we're not going to go over straight line method for premiums, but it's the exact same idea, just applied to a premium. So the interest expense is going to be the same each period, but it's going to be decreasing the carrying amount instead of increasing the carrying amount. But other than that, it's the exact same. So let's dive into this. The cash interest paid, this is the same calculation as in the previous question. $75,000, which is the face value, multiplied by the 5% stated rate, and multiplied by 6 out of 12, because again, this is a semi-annual payment. That gives us $1,875. Remember, this is not going to change, but luckily, with the straight line method, the discount amortization is also not going to change as we go on. So let's go down here to figure out the discount amortization. It's really easy. You take the face value, less the discounted carrying amount at the beginning, $68,250. That's $6,750 of discount, and we're just going to amortize that over the periods evenly. There's 5 years, 2 payments per year because it's semi-annual payments, so there's 10 periods. So $6,750 divided by 10 gives us $675 of discount amortization each period. It's the same amount the whole time. We add that to the cash interest paid, which is also the same amount the whole time. So for the entire life of this discounted bond, the interest expense is going to be $2,550 because the discount is amortized evenly throughout the whole life of the bond. Again, very simple. That's the only question we're going to be doing in these first 5 questions about straight line method. Now that we know that, let's go to the next question. All right, here we are at question 4. Using the effective interest method, how much interest expense should Orion Industries record for the second payment on March 1st, year 3? So let's go through this. On March 1st, year 1, Orion Industries issued 100 bonds at a 7% annual interest rate, each with a par value of $1,000. The bonds were issued for a total of $105,000 to reflect a market interest rate of 6%. The bonds mature in 4 years with interest paid annually on March 1st. So again, with all that, we have to figure out the effective interest method. We have to use the effective interest method to figure out the interest expense for the second payment, which is on March 1st of year 3. All right, so in this question, we're dealing with a premium, just giving you a heads up. You'll probably have to figure out why it's a premium. If you want, go ahead and give this one a try. Premiums are kind of the opposite of discounts when it comes to how it affects the carrying amount. But at any rate, go ahead and give this a try if you want, and come back when you're ready. If you don't want to, again, we'll look at the answer in just a second here. All right, here we are. The answer is A, $6,258 is going to be the interest expense for the second payment. Let's walk through this. Under the effective interest method, the interest expense is calculated based on the carrying amount of the bonds, which decreases over time as the premium is amortized. Here are the calculations for the first and second payments. So let's walk through this. This is very similar to a discount, just you treat the premium in a slightly different way, the premium amortization, I mean. So let's go through this. The carrying amount is $105,000 at the beginning of all of this. Again, that is the higher amount than the $100,000. And just in case you haven't really noticed throughout this video, I feel like I should address this if I haven't addressed it yet. This $100,000 is because there was 100 bonds issued at $1,000 par value. So 100 multiplied by 1,000 That's 100,000. So that's where that number's coming from. That's where we've been getting all of our numbers throughout this whole video. I realized that I hadn't said that, but again, it was kind of implied. So if that was confusing, sorry, I didn't mention that until now, but that's where that's coming from. So again, carrying amount, $105,000. We pretty much do the same thing. $105,000 multiplied by the market rate of 6% gives us $6,300 for the interest expense. Now we're going to actually jump down here to the cash interest paid first. $100,000, that's the face value multiplied by the stated rate of 7%. That's $7,000 cash interest paid. Remember, this amount, $7,000, is not going to change throughout the life of the bond. So $7,000 won't change. Now that we can see that, now we can calculate the premium amortization. It's just the cash interest paid less the interest expense, and that gives us a premium amortization of $700. You'll notice that the premium amortization is a debit rather than a credit because premiums are listed as credits originally, and then you're going to be decreasing the premium as time goes on, so you're debiting the premium, whereas with discounts, they are a debit when you first put them in the financials, and then you're crediting them to get rid of the discount, but they kind of act in a slightly different way. So anyway, we debit interest expense, we debit premium amortization, we credit cash interest paid, and the premium amortization is $700. We subtract that from the carrying amount. So with the discount, we were adding it to the carrying amount. This time we're subtracting it. So the new carrying amount after the first payment is $104,300. Now we go to the second payment, we do the same thing. New carrying amount of $104,300 multiplied by that 6% market rate gives us $6,258. By the way, that's the answer, but we're going to go a little bit further. $6,258 of interest expense, and then we can go down to the cash interest paid. That's always the same, $7,000. We subtract this $6,258 from the cash interest paid, and that gives us a premium amortization of $742. So you'll notice that premium and discount amortizations are both increasing as time goes on, but for different reasons. The premium amortization is increasing over time because the interest expense itself is decreasing over time. So therefore, to kind of like plug, or the difference between the cash interest paid and the interest expense is going to be increasing each time because the interest expense is going down each time because the carrying amount is decreasing over time. Whereas with the discount, as we talked about, the carrying amount is increasing over time, which means that the interest expense is increasing over time, which means that the discount amortization also has to go up to kind of match that carrying amount and that interest expense going up. So both times, premium amortization, discount amortization, both going up each time there's a payment. But since you're debiting the premium amortization, it's actually decreasing the carrying amount. And since you're crediting the discount amortization, the carrying amount is actually going up. So with all that, again, the interest expense is $6,258. And like I said, I'm just going to say it one more time. This progression shows how the interest expense decreases as the amortized premium increases. With each payment, the carrying amount decreases. So that's the difference between the premium and the discount. I think I kind of hit it home pretty hard there. Now let's go to one more question, question 5. All right, here we are at question 5. What is the total amount of bond issuance costs to be amortized? Okay, so now we know just by reading that last part, we're dealing with something a little bit different than what we've been talking about before. On January 1st, year 1, Lunar Corp issued $500,000 of 10-year bonds at par with a 5% annual interest rate. In connection with the bond issuance, Lunar Corp incurred the following costs: legal fees of $3,000, accounting fees $2,500, printing and engraving $1,500, and finally underwriting fees $7,000. So with all that, we have to figure out what the total bond issuance costs are that are going to be amortized. Now, we haven't talked about this yet in this video. If you have any idea how this works, that's great. Kind of figure it out and pause the video if you need to. If you have no idea how to do this, that's okay. Again, we're using these questions to learn how to do this. So pause the video if you want and come back when you're ready. All right, here we are. The answer is D, $14,000. That is the total amount of bond issuance costs that are going to be amortized. So let's walk through this. It's actually super easy to add all these up, but I'm going to kind of explain what bond issuance costs even really are or how they're treated. To calculate the total issuance costs to be amortized, add up all individual costs associated with issuing the bond. So that is a really easy rule to remember. If there are costs associated with issuing the bond, they are bond issuance costs that will be amortized. So just remember that all costs associated with bond issuance are going to be amortized. Okay, let's go here. Legal fees plus the accounting fees plus the printing and engraving plus the underwriting fees. So everything. You add that all up together, that's $14,000. So that's the easy part. Let's talk a little bit about what you do with bond issuance costs. Bond issuance costs are recorded as a deduction from the bond's initial carrying amount on the balance sheet, effectively reducing it below face value. It's kind of like a discount in that sense that, the carrying amount is less than the face value. These costs are then amortized over the life of the bond, 10 years in this case, and included in interest expense each period. This gradual amortization reflects the expense in line with the bond's term, ensuring costs are recognized proportionately over time. Basically, like I said, it kind of is like a discount in the sense that the carrying amount is less than the face value, and you're actually trying to get up to the face value after because of these bond issuance costs. They're amortized over time. So anyway, that's pretty much what you need to know with bond issuance costs. It doesn't go too much further than that. You just need to know how to add them all up and what they do. They reduce the carrying amount of the bond. And with all that, we've gone over a lot in just 5 questions. Let's do one more part of the Superfast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You see 3, 4, 5 questions trying to teach you how to calculate the interest expense on a discounted bond with the effective interest rate, or you see 2 or 3 questions teaching you how to calculate the interest expense for a bond with a premium using the effective interest method. You're just going to see these things popping up over and over again, and you're not focusing on things that are like a one-off question. You're focusing on things that are riddled throughout the questions that you're studying that day. And once you've noticed that, you take some time, kind of in your own words, kind of your own summary, you write down these pillar topics of the things that were most important from what you learned that day from the questions. And as you're doing this each day, you're going to be building your own personal repository of your own knowledge, your own words, of what is most important for the exam, so that you know what is most important for the exam so that you can study it. With all that, let's go to the pillar topics for this video. All right, here we are at the pillar topics. Again, kind of a summary, just a summary in your own words of the most important things you learned from the questions. You might summarize it a little bit different than me, but this is what I have right here. Calculating interest expense at par value. This was the easy one at the beginning. When bonds are issued at par, the interest expense equals the cash interest paid, as there is no premium or discount to amortize. So interest expense is equal to cash paid, to interest paid. It's the same thing when it comes to par value. Now let's talk about bonds issued at a discount. For bonds issued at a discount, the interest expense increases each period as the discount is gradually amortized, adding to the cash interest paid. So remember, with discounts, when they amortize, they are increasing the carrying amount of the bond, which means that the interest expense is going to increase each period because the carrying amount is increasing each period. And remember, the journal entry for this that really helped me kind of solidify understanding this, you debit interest expense and you credit interest payable for both a discount and a premium. But the difference comes in here, where with a discount, you're crediting discount amortization, and with a premium, you're debiting premium amortization. But we'll get to premium in a second. But again, remember, the discount amortization is going to be increasing each period because the carrying amount is increasing each period. And again, this also means that the interest expense is increasing each period. Now let's go to the bonds issued at a premium. For bonds issued at a premium, the interest expense decreases each period as the premium is amortized, offsetting the cash interest paid. So instead of the premium being added to the interest paid, kind of being both credits and both being equal to the interest expense, now the premium amortization is actually going to be added to the interest expense to be able to be equal to the credit of the interest paid. And remember, the interest expense decreases each period because the carrying amount of the bond is decreasing because you're amortizing the premium to get down to the face value instead of with a discount where you're trying to get up to the face value. So again, interest expense, always a debit. Interest payable, always a credit, at least in this situation. I'm not saying always. I'm just saying specifically with discounts and premiums. But then the difference comes in where you credit a discount amortization and you debit a premium amortization. And that, again, is what helped me really see what was happening, because I could see that with the premium, if I didn't have the correct debit, then this didn't balance because the credit wasn't going to change, and I could figure out the interest expense pretty easily. So that means that the premium was kind of the plug to make sure that the debits and the credits match. And then it's kind of the same thing with the discount. The debit is pretty easy to figure out, and the interest paid is always the same. So I just had to figure out what I needed to add to this interest paid to figure out the discount amortization so that these balanced. So again, not too difficult once you kind of remember those journal entries, in my opinion. So that's how those work. One last thing, bond issuance costs. Bond issuance costs reduce the initial carrying amount and are amortized over the bond's term, affecting the bond's carrying amount and total interest expense over time. Again, we didn't dive super deep into that. You just need to know that bond issuance costs do reduce the carrying amount of the bond when you issue it, and those will be amortized over time. But the main thing is you just need to know all costs associated with issuing a bond are considered bond issuance costs and reduce the carrying amount of the bond. And with all that, We've gone over the pillar topics for this video and the first 5 questions, and that is it. Before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, sign up for that webinar because it's free, it's 1 hour, and we will teach you how to pass the CPA exam without wasting months or even years of your time. We will show you the key ingredients to passing the CPA exam. And after you watch that, I'm pretty sure you're going to want to learn more because you're going to be excited. So make sure you check out becoming a Superfast CPA Pro member, where you not only get access to the Pro course, where we literally explain everything super in detail, step by step, how you're supposed to study. You not only get access to that, but you also get access to our full 10-question versions of these 5-question YouTube videos. Pro members of Superfast CPA get access to the full 10-question videos so they can get more practice and a little bit more explanation. So again, make sure you check out the free 1-hour webinar training and becoming a Pro member. And with all that said, thank you for watching. I hope this was helpful. If you liked the video, make sure to like it and leave a comment, and I will see you in the next video.